And then what we do is we calculate the standard deviation of our prices, of our price curve, and then we add the standard deviation to our moving average curve. So this is basically the lower band is the moving average curve plus the standard deviation, and the upper band is our moving average curve plus the standard deviation. So that generates a Bollinger Band. And so one of the interesting things that you can see here is that, for example, when our price curve breaks through the lower Bollinger Band, most likely we will see that after some time the price will increase again. So it will revert back to where it was previously, because it always oscillates within that band. Yeah. So when it hits the upper band, it will probably oscillate back to the middle or even back to the lower band, and vice versa. So this is how Bollinger Bands work. And this is also where we basically go, okay, we can use this, for example, as a indicator for mean reversion. And so there's many ways to do this. Probably the simplest is to say, well, once our price curve hits a band, and then we enter a position, and then we expect it to revert back. And then once it goes through the middle band, we close the position. Now, another way to do it is to say, well, actually, once it crosses the lower band, for example, we could still go down quite a bit. So what we actually want to do is we want to exit our position once it crosses back from below the lower band into the region. So we're basically, in this case, let's say it crosses back, we enter a long position, and then we exit that long position once we cross the green band, for example. Yeah. Or we could say, well, we exit once we cross the upper band. So the interesting thing here is it's always guaranteed to oscillate between those two. So it always will cross the middle band, and it will go and come back and so on. But it's not guaranteed that we make a profit, because while this might, in this case, for example, here crossing back, we can also see that our green indicator has moved. So that green indicator might actually give us still, or might actually still be below our crossing as time has moved on. And so there is actually no guarantee we can make a profit with it. But, it's definitely, to put it mildly, it's not an impossibility. So how can we convert this into a trading strategy? So first of all, what I do here now is I build us a event-based trading strategy. So we define a position indicator. We say, well, if impulse is 0, we are not in a position. If impulse is 1, we're in a position. And then what we do is we cycle through our prices. Yeah. So we can do for I in range length prices. Okay. And then once we cycle through the prices, we're cycling through our bands at the same time. So probably a good idea to not start with 0, but start with some higher number, say 500. And then we can say, well, our first entry condition is, for example, if our price is below the lower Bollinger Band. So if our prices of I is less than, and we say low, which is our lower Bollinger Band of I. Or let's do this. Let's do the crossing condition. If our previous prices are below the Bollinger Band and our current prices are above the Bollinger Band, we get into a trade, which means impulse equals 1. So we want to get into a long position. We actually have to make sure we say that we need to only do this if we're not in a position yet. So this is our entry condition, right? So if impulse is 0 and our previous prices are below the band, and now the next prices are above the band, we get into a trade. Yeah. And then what we do is we record an entry price, and the entry price is basically our current price.